Um, First of all, audits from an external standpoint are there to verify that the statements that you're reading present information fairly and in accordance with generally accepted accounting principles. They're not testing for fraud. They're not trying, the auditors are not looking for fraud. They may find fraud in their audit, but that's not what they're doing. So a lot of people think, well, they've been audited, of course there's no fraud. That's not what auditors are there to do. They're there to say that, yes, indeed, the accounts receivable are accurate. Yes, indeed, the inventories are accurate and reported on the basis of GAAP and so forth. Whether inventory disappeared before the end of the year, that's not really what audits are there to find out. So just remember that auditing is not looking for fraud, it's looking to verify the accuracy of the financial statements. The best defense against fraud happens inside an organization. It's called internal control. So when we're looking at fraud, we're trying to find out to create a system that is hard to game. It's hard to commit fraud with. Almost impossible to design a perfect system, but you can design a system that works reasonably well at finding and or preventing fraud. And most internal control systems prevent fraud, and they also prevent errors, or designed to prevent both. So when an auditor comes into a company, what they're doing is they are preparing, and these the financial statements you looked at for Kirby, you would find this for Kirby. I think this is UPS, pretty sure. Yeah, United Parcel Service is what this statement is for. So in the middle of the auditor statement, it says, in our opinion, the consolidated financial statements present fairly and in all material respects the financial position of United Parcel Service and subsidiaries as of a certain date, and the results of their operations and cash flows for each of the 3 years in the periods ending. So 3 years of financial income statements, 2 years of balance sheets, in conformity with generally accepted accounting principles practiced in the United States. So that's what the opinion of the auditor is. That's what they've done. They've looked at the financial statements, they've audited all of the accounts in the financial statements and said, yep, these are conform to generally accepted accounting principles and they are presented fairly. So that's what they do. Starting in 2002, auditors also had to audit the internal control program of any corporation they were auditing. So we've also audited down at the bottom here in accordance with the standards of the PCAOB, the company's internal control over financial reporting. And our report dated February 27th, 2012 expressed an unqualified opinion, which means a clean or a good opinion of the company's internal control over financial reporting. So that's the other thing auditors do, and that's relatively new. That started in 2002. This has been in existence since 1929, I think. So how did that internal control thing come about? Well, many of you have probably heard of Enron because it was a famous financial fraud, and WorldCom took place at the same time. And both Enron and WorldCom were audited by a single entity, a single auditing firm, CPA firm called Arthur Andersen, which at the time was the largest CPA firm in the world. They had 20 or 22,000 partners. They were a partnership, not a corporation. I had partners all over the world. I knew a bunch of them. They were a highly respected firm, but they kind of lost their way with these two situations. And then in turn, because of these two situations, they failed as a firm. They went financially bankrupt. And since they were a partnership, their partners lost significant amounts of money, each individual partner, and they are no more. So The consequences of these frauds both did away with Enron and WorldCom and a couple of other companies, and also the auditing firm. So what happened? Well, Arthur Andersen had a consulting arm and they had an auditing arm. And their consulting arm constructed with both Enron and WorldCom and figured out ways for them to do certain things that were fraudulent. Arthur Andersen may not have intended them to be fraudulent, but they certainly were used fraudulently. And then the audit firm came in and said, oh, well, if our consultant said that was okay, we think it's okay too. So by both providing consulting services and auditing services, they essentially ended up auditing themselves, Arthur Andersen did. And that was against all sorts of codes of ethics and was certainly not acceptable. So when something like this happens, usually, and lots of people get hurt by bankruptcies and so forth, the government usually steps in, and indeed they did. And in 2002, Congress passed something called Sarbanes-Oxley, which really changed the accounting world. So they created that Public Company Accounting Oversight Board, the PCAOB, which you saw mentioned in the information about internal control auditing. It's a requirement of the PCAOB that be done, so that was a new requirement. They also said corporate executives are responsible for the company's financial statements, even if they didn't prepare them themselves. So they have to sign them, and if there's a misstatement, there's a potential jail term and/or fines. And that came about because the Enron chief executive, who was taken to court and eventually convicted, his defense was, well, I'm not an accountant. I didn't know what they were doing. But he was the CEO. He needed to know what they were doing. They were acting as his agents or in his name. So the court did hold him responsible, but the government then said, hey, we're going to make this everybody's responsibility. Let's make it clear that if you're the CEO, you're responsible for your financial statements. They also said, in response to Arthur Andersen's problems, that if you're going to audit somebody, you can't provide other services to that client. So you can't be a consultant and an auditor for the same client. You can't be a tax accountant and an auditor for the same client. So if I'm going to work on your taxes, I can't also audit your financial statements. So that's a big change, because accounting firms used to do all those services, and now if they're going to do audit services for a client, they can't do the other services. There was a problem also with Arthur Andersen, the revolving door, so-called, where many Arthur Andersen employees and or partners left Arthur Andersen and went to work for these clients, the Enron and WorldCom and others, and then they were audited by Arthur Andersen. So you can't do that anymore. You have to wait at least a year before you can work in a position where your previous employer is auditing you. Audit firms have to have the board of directors hire their audits. Management is not allowed to hire their auditors because they're going to audit management. So we want to keep it as far away from that conflict of interest as possible. And then finally, what I've highlighted there, which we're going to be talking about going forward in this chapter, companies must express an opinion on whether management's assessment of the effectiveness of internal control is fairly stated. So internal control became part of the regulatory process, not just that your statements present fairly, but also that you have an adequate internal control system to prevent either errors or fraud. So that was a big change, and that's only part of the acronym SOX stands for Sarbanes-Oxley. That's only part of the provisions of the law, but those are the major provisions. So lots of stuff changed due to this scandal with Enron and WorldCom. Just so you know, what Enron was doing was they were in the business of trading energy, so buying and selling energy contracts. And they had set up a system where they would report their energy contracts that were profitable, that showed gains. And then some of their energy contracts that showed losses, they would isolate in offshore companies and not consolidate them with the financial statements. So they had their losses hidden in offshore subsidiaries, and their profits were reported on their financial statements. So it's sort of like going to a casino and you only record your wins, and your losses you ignore. And you say, well, I won a lot of money today, even though you lost as much as you won. So that's kind of what they were doing, only reporting their wins and not their losses. So the first thing that many people don't realize, including some managers, is that managers are actually required to represent their creditors first, actually, before their owners. So they're entrusted with resources by their lenders, and they have to safeguard those resources for their lenders. So the creditors actually come ahead of their stockholders in terms of responsibilities for managers. So that's called fiduciary duty. And it's basically, if something's entrusted to you, you're responsible to take care of it. You're responsible to manage it reasonably, rationally, and safely. So it's important to understand that even though I work for the owners of the company, I am responsible. I have a fiduciary responsibility to the creditors of the company. Important concept that a lot of people don't really think about, but it's definitely there. And if you do something that hurts the creditors, you are potentially personally liable for that. So, so internal control is about doing things to improve accuracy and reliability, as well as safeguard the company's assets. So I'm trying to do something to keep my books and records accurate so that we don't have errors creeping into our books and records, and also to keep people from misappropriating assets, whatever those assets may be. Ways to get internal control. The first thing I always say is that whatever happens in a company generally comes from the top. You may or may not have heard the colloquialism that the fish rots from the head, and that indicates that if the top of an organization is rotten, then the rest of the organization will be rotten. And the same is true if the top of the organization is ethical, generally the whole organization will be ethical. So the ethical tone set by top management is very important in any internal control, and that's something that auditors actually look at. What's the ethical tone within an organization? The second thing you look at is what's the consequence if we have less than good internal control in a certain area? And that really comes down to materiality. Is the risk large enough to justify the control? Or if I have no control here, am I still going to be okay? So if I'm in an office environment and I'm trying to control pens and pencils, even if I don't have good control on pens and pencils, the risk is pretty small. Even if my employees all leave with lots of pens and pencils that don't belong to them, that's probably not going to have an effect on the organization. So it's not worth controlling pens and pencils, perhaps. But if I have lots of dollar bills lying around, then maybe I do need to control the dollar bills. The best method devised thus far in any kind of internal control system is separation of duties. That is, having more than one person involved in each set of transactions. So don't let somebody be both the person who bills customers and also the person who collects or records the receipt of money from customers. Don't let the person who signs the purchase order be this person who pays the suppliers. All of those things, you want multiple people doing things. So I had a little computer glitch there. A computer decided to shut down, but we're rolling again. And we will continue. So what is fraud? Well, there's your definition at the top there. Fraud is the intentional deception for the purpose of financial gain. Fraud can be small or it can be huge, like you may remember Bernie Madoff and his $65 billion Ponzi scheme. So there's possibilities for fraud to be quite large or quite small. And there's different kinds of fraud. So the kind of fraud that we all are kind of familiar with and can understand pretty well is stealing, or misappropriation of assets is the bigger dictionary word for that. So taking something that doesn't belong to you. And that's pretty easy to understand. I steal something so that I can use it myself. I take it from the rightful owner and misappropriate it, take it and use it for my own benefit rather than the owner's benefit. That's pretty easy to understand, but there are other types of fraud that take place within accounting systems, which are financial fraud, misstatement of financial information. So I can misstate my financial information so that I overstate my revenue, understate my expenses, overstate my assets, or understate my liabilities. And every one of those can have significant consequences both to the company that I'm doing this to or with, the individuals who are outside the company, both lenders and investors, and also potentially to me. So we'll talk about how this might benefit the person who commits this fraud. So why would you do it? Well, I steal to use stuff for myself, but I misstate financial information, maybe to increase my compensation. Maybe my compensation is based on profit, let's say. And if I overstate revenue, then my profits look better and I get a bigger bonus. That's a good reason to, well, that's certainly a personal benefit. I didn't steal any money and take the money, put it in my pocket and run, but I did the same thing sort of a different way. Maybe I just want to keep my job. Maybe performance has been poor in my department and I want to make it look better so they don't fire me. Loan covenants. You're going to see some loan covenant information when you're working on your common sizing. Why does it matter? Well, if I violate the loan covenants, if the loan covenants say I have to show a certain level of profit or a certain kind of level of liquidity, and I don't maintain that, then the loans immediately become due right now. So I might choose to falsify my financial statements in order to not trigger a loan covenant. The other thing that misstatement may do is it inflates stock values, increase the level of my stock options if I happen to have stock options, so it may help me personally, or it may increase the value so the company can do more acquisitions. So sometimes financial fraud might be for the benefit of an individual, or it might be for the benefit of the corporation. So different possibilities there. So how do I overstate revenue? I overstate revenue by recording fictitious revenue or recording revenue before it's earned. And the second one is the more likely. So I have a contract. I've signed a contract with somebody to provide them with services. I haven't provided any of the services yet, so it shouldn't be reported as income, but I do report it as income. So I haven't earned them yet, but I'm going to report them. So I'm pushing revenue into the current period that really belongs in some future period. That's a overstatement of revenue, and that's actually fairly easy to do, and not that easy to find from an audit standpoint. So not saying that it happens all the time, but it certainly happens. Understate expenses. Capitalize some item that you think should be expensed. So I have to do a major repair on my ship. And it costs a couple of $1 million, but it's just a repair. It doesn't extend the life of the ship. It doesn't make the ship operate any better. It's just a repair. I should expense that, but maybe I'm tempted to capitalize it and spread that expense over a number of years rather than just expensing it. That would be an understatement of expense. I'd hide expenses, or I might delay the reporting of expenses. So count something as a prepaid expense when it's really an expense currently. Overstate assets, so overstate cost value of something, or in a fair value situation, overstate the fair value, or record assets that don't exist, phantom assets. So that's how I go about committing that kind of fraud. And then understating liabilities. I can do that with a timing situation by not reporting them at all, or as Enron did, by getting them off the balance sheet, putting them on the balance sheet of subsidiary that I don't consolidate into the full financial statement. So I hide it off balance sheet. So that's an understatement of liabilities. All of those things are ways that people commit financial fraud, and financial fraud is serious stuff. So it's things that you don't want to have happen, and you want to have an internal control system that hopefully makes it more difficult to commit either stealing or financial fraud. And that's the purpose of internal control. So I've got a couple of examples of I don't know how this is going to work online or if it'll work at all. Let's just see. If not, I'll just tell you about it. Let's see if that will work. Yeah, there we go. So now I should be able to shrink this and put this in here. Oh, look at that. So all I want you to see is the picture of this sweet little old lady here. Who would think that she was someone who might commit financial fraud? Well, she did. She worked for the Catholic Archdiocese of New York, and she stole $1 million or thereabouts. And she did it because they had a really lousy internal control system. So she basically created checks to herself or to an account that she could deposit them in. And then she went back to the books and financial records and changed the name of the recipient of those checks to a regular vendor who did work for the Archdiocese. A number of different vendors, but changed the name so it couldn't be traced to her. And she did that over the course of 6 or 7 years and stole about $1 million. She was a sweet little old lady. Her coworkers said she prayed often. Other coworkers said she went to mass almost every day. Somebody else said, well, she always did the flowers on the altar. And everybody had good things to say about her. She wasn't such a good person. So she looked good, she sounded good, but she wasn't good. So that's not unusual. Embezzlers are usually con artists to a great extent, and they can put on a pretty good facade even though they're not particularly good people. And in this case, she wasn't. Sometimes embezzlers get caught because they start living beyond their means or beyond what they should be able to do given their salaries. She didn't do that. She liked to collect fancy dolls. So when she was arrested and they searched her apartment, they found lots and lots of fancy dolls. So that's an embezzler. The second one I have here is closer to home for people from Maine. Maybe, I don't know if any of you originally are from the south coast, the mid-coast area of Maine, but this is see if I can get this into your screen. This gentleman here was the voluntary president of the Mid-Coast Charities, which is sort of a United Way charity. They collected lots of charitable donations, and then they provided them to things like the YMCA and boys clubs and that sort of thing. So they collected funds and provided them to various charities. And he was the voluntary president of that organization for 20 years. And during those 20 years, he stole almost $4 million. And he got caught only after he retired because he wasn't there anymore to protect himself, basically. So his way of stealing money was he would go and collect money from big donors. So say you were a donor and you gave $20,000 every year to this charity. He would go and collect the money, and one year he'd put it in the charity, and the next year he'd put it in his own account, and then the next year he'd put it in the charity. And after he retired, the new president, also a volunteer, went to a prominent donor and said, hey, we haven't gotten a donation from you yet this year. Do you think you could come up with the money for a donation? And the donor said, oh, I gave you a donation, but the charity never got it. It went to this gentleman here. So this gentleman is now in jail for the rest of his life, though he's quite elderly, so that may not be too long. But he was voted the best citizen of Rockland. He was always held up as a pillar of the community. And having read a little bit about him, I think he started without the intention of being a thief. He had some troubles in his business 20 years ago. He was the president of this organization, and he needed some money, and he took it, probably with the intention of paying it back, but it was so easy to take, he kept taking it. So internal control systems are designed to prevent that sort of thing. And make it harder to do. Doesn't make it impossible, make it harder to do. One thing they can't do is be perfect. They're always beatable. And since the number one way to create internal controls is to use separation of duties, if people collude, they can get around that. So if you get enough people working together, they can usually beat the system. The idea is, from an internal control standpoint, if you make it so that it's necessary to have a number of people working together to steal, then the chances of one of those people either being stupid and getting caught, or maybe having a pang of conscience and reporting the others, is far greater. But if you get 3 or 4 or 5 people who are dedicated thieves, good chance they'll get away with it, at least for a period of time. So internal controls, number 1, have a good culture. Number 2, don't allow transactions that don't have an audit trail, which means they don't have a paper trail. So you might want to make sure that there's always an audit trail. Separate duties, which we've already talked about. Make sure that there's always authorization, and sort of tied to that audit trail is make sure that there's documentation. Have physical safeguards in some case if necessary. Bonding is something that most people who are involved in financial parts of companies are bonded. That's an insurance situation. So you pay a company to bond an employee for a certain amount of money, and then if they do indeed commit fraud, then the insurance will pay the company how much, whatever the fraud was. But bonding companies also do background checks and so forth that might be more sophisticated than you're able to do yourself. So bonded employees are usually background checked a little more than other people. People who don't take vacations are absolutely suspect, because if you are an embezzler or any kind of a financial fraudster, you basically can't leave, because as soon as you leave, somebody else starts doing your job. They'll figure out that you're doing something unusual or illegal. So generally, the hardest workers are the people you're most suspicious of as an auditor. Rotation of duties has the same effect as taking vacations. Don't let one person continue to do the same job for years and years and years, even if they're really good at it. Make sure you rotate duties. It can also be a good way to develop skills for employees. Do performance audits and do cost-benefit analysis. You don't want to put controls in place that cost more than they can possibly return. So make sure your controls aren't so onerous that they cost more than they're worth. You can prevent fraud by focusing on ethics. Leaders who are ethical generally have ethical organizations. Audit trails, we've talked about. Separation of duties. Always separate duties, especially cash transactions, but all duties should be separated. Make sure you follow procedures. A lot of us who are in operations get really frustrated with the procedures. Why do I have to do a purchase order? I know exactly what I want. I know where to get it, but I know the best price. Let me just buy it. Why do I have to fill out a purchase order and have it approved? It takes time. It takes my time, and then I have to wait for the part and all of that. The reason for that is that you might be ordering that part for the engine you're working on, and then at the same time order a part for your car. And who's going to know unless we have a procedure to say, this is what was ordered, this is what came in, and this is what we're paying for. So that's why there are these bureaucratic procedures. They're not just to be bureaucratic. You want to make sure they're good, but not so bureaucratic that they hurt the organization. So um, I always get frustrated with these things, but I understand why they're there, so I go along with them. Simple things like don't leave cash or blank checks around, back up things off-site, um, and definitely if you have particularly valuable inventory, you need to protect it. Bonding, required vacation, rotation of duties, we've talked about that. Internal audit departments, many large companies have internal audit departments which both design control procedures and can perform continuous audits, reviews to see that they're complied with. Really important. If you work for a larger company, you've probably experienced these. External auditors aren't looking for fraud. They're looking to make sure that the financial statements present the financial position fairly. Internal audit departments are looking for fraud, and they are very important to make sure that not only do we set up an internal control, but that we also follow it. We don't run around it. And definitely make sure that your systems are cost effective and understand that no system is foolproof. If somebody really wants to steal or evade the system, they probably can. So that wraps up chapter 18. Thank you for listening, and there'll be some questions after the chapter.